welcome to our mid-year review and crystal ball update. I'm Katrina Radenberg, Chief Investment Officer at Mariner, and with me today is Jeff Krumpelman, our Chief Investment Strategist. Jeff and I have now hosted this call together for the last 6 years, and it has become a tradition for us to share this time with you in January and July of each year to reflect on what has been and to update you on where we think the markets are headed. Today, we will cover the first half of the year, what to expect for the second half of the year, while also highlighting the key risks out there that would impact our expectations and cause us to adjust our outlook and strategic positioning. Jeff, welcome once again.
Thanks, Katrina.
Good to have you here. I always enjoy the chance to do this with you, particularly in a year like this when the markets have provided our clients with such robust returns, at least so far this year. So glad to have you here. We want to thank all of you for joining us today. I think you will find that we continue to have a constructive message. The major difference between this year and last is that our positive message in 2024 is more consensus in nature versus our contrarian positive view last year when most of the world was quite cautious. We'll demonstrate today that we are quite comfortable being either contrarian or more consensus in nature if the data supports our view. We are not biased to seek to go with or against the grain just for the sake of standing out or blending in. We embrace our outlook based on thorough research and facts on the fundamental valuation data and technical metrics, or the FVs and Ts as we call them. Today, those metrics still tilt to the positive and reflect normal, healthy conditions. In some ways, the financial metrics are better than they were this time last year. Therefore, it should be no surprise that we remain positive and continue to suggest that clients adhere to their long-term strategic allocation to stocks. We feel that a measured tone and associated positioning is appropriate rather than buying into some of the more extreme views and rhetoric that have been in the headlines throughout the last couple of years. Jeff, any thoughts that you want to share before I provide our audience with a quick recap in the first 6 months that will then lead us into the specifics?
Yeah, I do have just a couple quick thoughts. Thanks for kicking this off, Katrina. And I'd like to pick up on just one point that you made in those introductory comments. You mentioned that the metrics this year are better in some ways than they were this time last year when we had equally strong returns, about 15%, positive returns last year in the first 6 months, about the same this year. And they were positive in the first 6 months of last year, despite the fact that the mood was very negative. People were really concerned, and investors, quite frankly, were crabby. And yet the returns were robust and in line with our thesis last year that 2023 was likely to be the inverse of 2022, when we had a positive view, unlike many, many others. And the reason that they were strong is different from this year. It was simply that it had been forecasted that earnings were going to collapse, that we were going to have a major recession. That was not, our base case view. And there was a big relief rally because disaster, didn't strike. And the fundamentals and the valuations and the technical metrics remain positive despite this kind of crazy move. This year, you have more consensus thinking, more positive outlook because you didn't have that disaster. And I think the main point that we want to make here is that we think it's very important. The reason we have a constructive outlook today is because we look at the trend. We don't predict the predictors. We don't predict reversals in the data. We simply follow the trend and listen to what it's trying to tell us. And it told us the same thing in 23. It's getting less worse. It's not going to be as bad. It's still pretty solid. The economy's growing. Earnings are not collapsing. And this year, they're actually accelerating, to a pretty healthy degree. So it's following that trend, not getting caught up in trying to predict reversals. Now, a couple other things I'll just mention. I think one of the key data points in looking at the fundamentals out there is inflation and the trend in inflation. And a big part of our constructive outlook was recognition that inflation peaked actually in June of 2022. There were all these theories out there that this was going to be an ugly wage price spiral like the 1970s. And the data actually peaked in June of 2022. But many people just, either chose to ignore history or not look at history. The bear camp remained frustrated because while inflation peaked and started to roll over, their story was, well, it's still high and it's not perfect. It's got to get to 2. The Fed wants to see 2. If you study history, we note that this has happened many times in the past. In the 70s, the 80s, the 90s, many times of surging inflation. And in each case, it wasn't perfection that the market needed to see. It was simply that it peaked and it was getting less bad. And in fact, I think 2023 is a perfect example of history repeating and that tendency as the market is up 40% from that peak in inflation of June of 2022. And if you look at those other periods, on average, the market advances strong double digit if it just gets less worse. And that's what we were really looking at. And then finally, the only other point that I'll make here, up front earlier is a big part of our constructive kind of thesis for 2024 is that it's broader than inflation. This is a mosaic. There's a lot of metrics we look at. And it's about a shift in transitions. The transitions beginning in late 21 and 22 were all negative. You had supply chain bottlenecks coming out of the pandemic that were a real challenge. You had inflation beginning to surge, actually, because of those supply chain bottlenecks and labor market shortages. You had a Fed that, because of that, was saying, oh, we got to hike, we got to get restrictive. And then you had the bear camp starting to talk about, to a big degree, oh, we're going to have a major recession and earnings are going to collapse. And all those things have transitioned from headwind transitions to tailwinds. You got, in terms of supply chain bottlenecks, they've largely improved, big degree. Labor market is easing up. The tightness is easing. If you look at the number of people quitting, that's in decline to, a big degree. The number of openings out there, so you can quit and just go wherever you want, there are fewer, and that's taking pressure off of wage increases. And in fact, plans to hire are still healthy, but they've come in, and we're getting growth in labor force for the first time in quite a bit. So that's easing up. And then you've got, in terms of the economy, we just got GDP today at plus 2.8%. with strong consumer, pretty balanced, and earnings actually look to be double digit this year and next year with rising margins. So all those transitions are positive, despite the fact that you always are going to have, headlines that are kind of tough. So, that's a big part for these positive transitions for our constructive view.
Thanks, Jeff. Those are great thoughts on the transitional shift from headwinds to tailwinds. Before I transition the conversation into addressing the specifics of the outlook and key risks over the next 12 months, why don't I go ahead and provide a quick recap on returns for the first half of the year and our take on them? How's that sound to you?
I think that's a nice play on words. I'd transition away, Katrina.
I mean, how many times can we say it? Okay, diving in here. Maybe. There we go. Okay. All right. So as we dive in here to take a look at the first half, obviously the first 6 months of 2024 were as equally kind to investors as the first 6 months of 2023. And that's saying something, knowing that the calendar year total return in 2023 for the full year exceeded 26%. As you said, Jeff, returns for the S&P 500 in both 6-month periods at the start of these 2 years were robust and approached the 15% level in each. And as you see on this slide, it was deja vu all over again with regard to the first half return data. Just like last year, the S&P 500 has hit our 2024 calendar year in projected price target well in advance of our expectations. Had we been speaking to you last week, where we were actually well above our year-end optimistic price target of 5,400 when the market was around 5,600, and today I think we're ending right above 5,400. So regardless, we've still hit it faster than anticipated. So again, we're seeing a bit of a repeat here. Last year, our base case target of 4,500 for 2023 was also achieved slightly after the mid-year break in early July of 23. So like last year, we are not raising our calendar year-end target. We believe an assumed PE ratio of 21 applied to consensus 2025 earnings in the midst of the current interest rate and inflation environment is rational and realistic. We see no reason from a fundamental standpoint to raise our forecast. If investors want to become super giddy should the Fed begin to cut rates soon and drive a market melt up by lifting the PE substantially from here, so be it. It's also important to note that we believe it's overly nuanced and foolish to attempt to make short-term 6-month predictions on the market direction. Rather, we focus on simply getting the intermediate and longer-term 12 to 15-month price trends in the market correct. Therefore, instead of raising or adjusting our year-end price target, which is just a short 5 months away at this point, we are diligently updating our forecast by extending the horizon period out to mid-2025 and introducing a new base case target of 6,000 or higher with an optimistic target of 6,600 over that longer term 12-month period, which would take us into next summer. I know you'll discuss this a little bit in more detail, Jeff, so I'll stop there on that piece of it. But we believe this is a much more productive exercise than what we see employed elsewhere. We do expect new highs in the S&P 500 by July of next year and anticipate positive trend over that time frame. This practice of completing a mid-year review now in July and then again as our crystal ball comes up in January really helps to allow us to keep you all informed on a rolling basis of our views over those 12-month periods. Jeff, any other comments that you would add in regards to this slide or anything I just mentioned?
Maybe two thoughts, and I know we'll cover just the rationale for why we forecast as we do and how we update our horizons and targets and that kind of stuff in detail in just a second. But just with regard to the review and the numbers that you have up, on this page and maybe the rationale for some of the strength in the numbers, I'll just point out down below, you can look at the Russell 1000 Growth Index versus the Russell 1000 Value Index. I think we were pretty loud going into this year and throughout last year that many folks were recommending, if you looked at peers and other strategists, that it was going to be all about value. And we may be seeing a little bit of that shift underway right now, or rotation a little bit where that gap will close. But you can see that it was very helpful to remain and have good exposure to growth equities and growth stocks last year, not just make this extreme run to value, as in the first half, growth stocks were up 20% as a group, and value stocks were up 6%. And then you can see for the 12 months ending June 30th, a big gap, 33%. Growth stocks were up 33% versus 13%. And I think we got that right in saying blending growth and value together. Don't abandon growth. There's a reason, good secular growth here. The other thing is that as we talk about kind of the transition from 23 to 24, our theme last year was contrarian. 23 is going to be good because 22 was horrible. And 24 is just going to be a return to normal. Conditions are normalizing. Inflation's going to come in. The Fed's going to kind of normalize policy. Earnings are going to be kind of normal. And it's just normal. And the fundamentals, the valuations, and the technicals were solid throughout both of those periods. but the nature of them has transitioned just a little bit. Last year was about inflation getting less worse, earnings holding up better than feared. This year, you're seeing actually the economy slow just a little bit, but inflation has calmed, interest rates have come in. That's allowed margins to stay pretty healthy. And this year, it's going to be about growth. It's going to be actually about delivering that earnings per share growth and the multiple just holding up, not expanding like it did last year, as things just were better than people feared. So the fabric of those FETs is just a little different, but in both periods, they were healthy.
Yeah. Sounds good. Thank you for adding those comments. So let's talk briefly about what we got right and what we missed in the first 6 months of the year.
Yeah, we can do that, and dispose of this because I think we've already mentioned some of these things. So we did get right. We had a target, you mentioned 5,400 for the S&P for calendar year, which is a nice double-digit return for the S&P 500. So we got that trend right, and that's what we want to do first and foremost. The strong showing for growth stocks that we just mentioned, we stayed with. We thought we would have solid economic growth in the neighborhood. Talking with Bill Greiner, our beloved colleague and chief economist, 1.5% to 2% growth, and he's been just very solid with thoughts about GDP and just the various growth statistics out there. We thought inflation would calm, and that was a real wild card. People were all over the map about it, and they weren't happy, they were crabby. The alphabet soup, and we'll go into this, inflation continued to calm, and intermediate rates, they peaked at about 5% in October of last year. That got our attention, but we really thought that they would come in as inflation calmed and the economy, kind of just moderated a little bit. And that indeed has happened. We're down to, 4.5% on the 2-year-ish and 4.2%-ish on the 10-year. And those are still healthy levels that provide a return, but they're well down from the peak levels that we saw on intermediate bonds. So we got all that right. I guess in this, I wish we could kind of frame this. When you get stuff wrong, this is the kind of stuff you'd like to get wrong. The gains were earlier and better than we thought. Got the trend right, but just the 5,400 came a little bit quicker than we thought. And the magnitude of the outperformance of those growth stocks was probably a little bit greater. But again, we got that directionally correct. So I think you and I can live with this in terms of, kind of the ledger. And hopefully it looks like this a lot. That would be a nice thing to see.
Well, maybe we'll frame it for you and it continue to be something to shoot for going forward. All right, so let's now tackle the harder part of our job. Let's discuss expectations about the future. I mentioned earlier why we don't embrace commenting on the very short term and don't engage on adjusting year-end targets unless we envision a drastic deterioration in our longer term 12 to 15 month outlook. And as you and I discuss, such an exercise just seems like we're trying to be cute, since so many things could impact the next several months while longer term trends still remain intact. And so instead, we tend to focus on looking out over the next 12 to 15 months and getting that longer term directional trend right. Mostly because we believe that this approach best serves our clients. But with that as the backdrop, can you discuss our relatively positive view about the coming 12 months?
Yeah, I can. And before I get into this page, which we can, cover pretty quickly, just talk about that overall idea that we don't revise up and, change target for end of year if we think that over the next 12 months, the backdrop, the fundamentals, valuations, technical support moving higher to 6,000 to 6,600. It just seems like that's a fool's errand. There's no real productivity in it. We all know that there's plenty of wall of worry items out there to spook investors, at any moment, whether it's the election and the market does tend to trade down a little bit going into the election, and then you get the recovery, at the end of the year. There's, war. There's still people, the Fed are they going to cut in September, October, never, what's going on? And all those things can push the market around a little bit and cause volatility. But I have no idea why you would go about either trying to hike your target, for the next 5 months, and scramble to do that, or, suggest to your clients that, well, wow, we're at 5,400. I guess we ought to, reduce or do something, to trim stocks. It just makes no sense if you think we're headed to 6,000 or 6,600. And we really try and prevent our clients from suffering from whiplash of those temporary moments of volatility that can be caused, as a normal course, part of a back to normal thesis, that are short-lived, and then we go on to higher highs. And as great examples, if you would have, swallowed the Kool-Aid of the negative headlines in December of 2018 and, trim stocks at that moment when the S&P was off 21 or 22% intra-month in December, you would have missed a fantastic 2019 where we went to higher highs and we were up 30% in 2019. And we did what we're doing right now. We stayed focused on the next 12 months, not on, oh my gosh, are we going to get cute about the short term? That's just a fool's errand. 2020 is a great example. In that pandemic month of March, the market was off over 30% in like 3 weeks. It bounced well over 50% off the bottom and was up 18% for the year. And boy, clients would have felt horrible if they trimmed out of temporary fear of volatility and then missed, the longer term when the backdrop remained solid. So that's why we do what we do. And so in that spirit, we lay out the next 12 months. This is our forecast for looking through June 30th of 2025. We think that there's a 60% probability that the market, S&P 500, will be at 6,000. That's a 10% price return, about a 12% total return. And it's pretty straightforward. We think that as inflation calms and interest rates kind of stabilize, you can maintain a 20 to 21-ish price to earnings ratio. And earnings, we got earnings reports coming in right now, 80% are beating. They're in line with expectations. And we're looking for earnings growth of about, 10% or so this year. You maintain your multiple, you get that 10%, price return. And we think that there's a small possibility that folks get giddy and they actually bid PEs up to 22 times. And if you think that's crazy, I mean, that's where we were a couple of years ago. They've been as high as, 25 times back in the go-go 2000 days. We don't see them going there. But we could see if the Fed does cut in September, you could get some cash coming in and a little, giddiness that could expand that multiple up and you get even a stronger return. There's a disappointing case. We always look at things that could occur. The backdrop for, we're saying 70% of 6,000 or higher. The backdrop is not all that crazy in terms of achievement. Real GDP growth that continues in steady Eddie kind of mode, 1.5% to 2%. We got 1.4 in Q1. We got 2.8% in Q2. We think it will kind of level out for the year at 1.5 to 2. And longer rates kind of staying in this realistic range, probably coming down a little bit from where we were certainly, last year, but hovering in this 375 to 475. So what could go wrong? The disappointing case would be flat. That's not travesty, but, perhaps inflation, for some reason, we don't see this at all. It ticks up just a little bit, or unemployment is a bit higher than folks would like to see, and there's a bit of concern about earnings, and we get a little bit of PE contraction, but we still deliver on the economy and earnings. And then the pessimistic case would be where you would get both the economy slowing down, earnings being lighter than expected, and the PE contracting more to like a 17.5 or so multiple. And then you've got, a double-digit return that's not insurmountable or travesty, but people aren't going to like that. We think that that's a small probability, 5% or so. But, we constantly are thinking about what could happen and what would we do. And so, this lays it out. We lean, try and get price trend right. And overall, we're constructive on where we're headed.
Yeah, no, that's great. Great overview. Thank you for that. So we've touched on a couple times, we've mentioned the FVs and Ts already today. But can you touch on the several components that drive our positive conclusions here? And maybe also just repeat for those tuning in why we call this our yoga chart.
We call it our yoga chart because I know you love yoga.
I do.
And even I think you practice it pretty often, but I do a little bit of it and it lowers my blood pressure, and you relax, and it's both a little bit of physical and mindful, both. And when I look at this and I'm reading the headlines and I'm freaking out and getting nervous like any human being does when they, look at the stock market and check out the New York Times and the Wall Street Journal and Barron's and all the stuff online, you can get caught up in the emotion. So you got to go back to the data, the objective stuff to bring down your blood pressure. For all those on the call, if you look at this and we're constructive, and yet we look at these three different levels of analysis that we follow. We look at the fundamentals of the economy and the financial markets. We look at valuation levels of the markets, and we look at the technical price trends and sentiment out there that gets at the psychology of things. If these three things are red and negative, and we're positive, don't believe what we say. These are all neutral to constructive. And this has been the backbone for why we have also been hold your ground and constructive in 23 and 24, and telling people to be at your long-term target and don't get uber, negative on things. So there are all kinds of subcomponents under here, under fundamentals. This is really probably neutral to positive. The economic trends are solid. The economy is slowing just a bit, but we got data today that says, you know what? Real GDP growth is in that kind of 2% plus handle. The consumer spending. Why? Because real personal disposable income, that's after inflation income, is growing, and they're spending on experience. And even in the goods category, we had a little bit of an uptick in goods. You look at industrial production, you look at retail sales. We've gotten some good data lately there. Yes, there are pockets of, weakness. Housing is not where you'd want it to be. Capital spending is plateauing just a little bit, but still healthy, and construction employment is at all-time highs. Overall, this is at worst case kind of neutral to positive. Earnings are, I just said, and we got a graph on this in just a bit, double-digit earnings growth with solid margin trends. And then you got Fed policy moving towards when are they going to cut, not how high are they going to hike. That is definitely neutral positive. We're pausing now. And then you look at things like interest rate trends, they've stabilized, credit spreads are very healthy. Valuation, you can get crabby about some of those magnificent 7 stocks being at 30 times plus earnings, but their fundamentals are really solid. We wouldn't short them for sure. And we own some of those, we don't over own them, but we own them. The non-mega 7, the other 493 stocks in the S&P 500 are priced more like it's 17 times earnings. And we find that health. Many are priced below that. So we think that valuation in a big part of the market is solid. So that's kind of neutral. And then on the technical front, we see the number of stocks advancing versus declining in very solid territory. The percentage of stocks trading above their 200-day and 50-day moving average look solid. And if you look at stocks and their longer-term price trends, they're not breaking down. They're actually, pretty darn healthy. And the headlines will say, "Oh, it's all about the Magnificent Seven." Well, you got a group that had been until this week really doing super well, and everything else just doing well. That's not the same thing as 7 doing well and everything's going down. That's a bad thing. You don't see that negative divergence. You saw some doing really well, and you see the rest doing pretty darn well. And we're seeing some rotation, some broadening, but that's a healthy thing overall. So you move this, you mix this in a soup pot, and it's normal, it's positive, it's not ragingly bullish, it's not ragingly bearish, and therefore that's hold your ground, stay at your long-term target. That's what it says to us.
Great. Did you want to cover anything on the next slide on the earnings front? Or did you
I
already-
do.
Okay.
If you do
Yep.
fast forward to earnings, I just want to show this to people because this gets lost, I think, in moments. We say that this year is about earnings growth more than it is P expansion. We got that expansion last year, so now you need to get earnings delivering. And so just wanted to show you, we've got in that yellow line, that's 2023 earnings. The blue is expected 2024 calendar year earnings for the S&P 500 of 242 a share in the S&P 500. And then the red is 2025. The purple is 12 months forward. That's from June of 2025 through June of 2026. And the green is consensus earnings out there for 2026. It's kind of hard to say, hey, man, I have clear visibility into exactly what earnings are going to be in 2026. We'll see. But, if we look near term in kind of these areas in which we forecast and we think about things, that yellow line, the bear camp was saying that's going to be more like 190 or below. It came in at 217 because the fundamentals and the technicals were holding up quite well. So we didn't get that earnings collapse. So that's in the past. This year, we're seeing earnings beats at a above average level so far, and guidance looks pretty darn solid. So that's good. And then when we look forward for drivers and catalysts, as the market broadens out, and it's not just the Magnificent Seven driving earnings, it's other areas like financials and industrials, from catalysts like capital spending and a yield curve that becomes positive sloping as we seem to be transitioning to that. Those are all good things. And so it's driving earnings going forward. So the earnings story is solid. And you can see the margin trends on the right. They fell off in 2022 as inflation came up, and that made it tougher to make those margins. Revenue was solid, nominal growth was solid, but there was cost pressure. Well, now that's easing and margins are going back up. So again, this is part of the yoga chart story. This lowers your blood pressure when you look at this stuff. If it's going the other way, we're not going to be out here saying, oh, we feel, like we're in a back to normal environment. We wouldn't be saying that.
Yeah, no, great detail. And I hear you saying it's our yoga chart or maybe an anchor even to keep us grounded in the facts, no matter what the headlines might be saying. So let's switch gears now and talk about the key risk items out there. So some are what we would refer to as legacy issues that remain in the news, ongoing speculation about Fed policy and inflation, politics and the election that is heating up, if not boiling at this point, and geopolitical conflict. These all serve as examples of those. The narrow market leadership also remains a concern in the headlines, which you've mentioned. Can you discuss how we view these issues at a high level and assess these risks?
Yes, and I think, yep, there you go, perfect, right on cue. We always do this rolling wall of worry. What are the items out there? And you see them on the left. These are the headline issues. And then again, we focus on the data, and do these headline issues have a high likelihood of spilling over and impacting these things on the right? And I just give you my executive summary. We think it's worthy talking about those top three, and we'll go into more detail, but I'll give you the executive summary in this part of the conversation on those top three. Speculation about Fed policy. When are they going to cut? By how much? All that stuff. What do we think? And what's the impact what about the election? Everybody, my gosh, you'd have to be Rip Van Winkle not to be thinking about, the election with an assassination attempt, followed by a sitting president saying I'm not going to run, and we get a last minute kind of person stepping in. And then what about this, man? I keep hearing about the Mag 7. Should I own Nvidia? Should I own all of them? Is it crazy? Is it a bubble like 2000? What do we think about all these things? And here's the executive summary. We think that the Fed is in the driver's seat right now. And we think that because of reasons we've already discussed, inflation truly has peaked. And we got some more inflation data today that showed that it continued to come down and move towards that 2.5% kind of level that the Fed's looking for, or better. And the Fed, because of that surge in late 21 and 22, and the stickiness even through parts of 23, they said we got to focus, even though we have two missions, and that's price stability and full employment and economic growth, they got to focus on inflation. Now that it's coming down into levels, they can now be concerned and keep an eye and make sure the economy doesn't slow too much, and cut when they are ready to do that. And in the most recent presser, when Powell was asked, do you think we're moving towards that 2%? He said, quote, I do have some confidence in that. Now, that's not going to knock you out of your chair, but that's about as dovish as that guy's been in I don't know, how long. So we think that they're in the driver's seat and they've got rationale to cut at some point. They're not forced to do it, and that's a beautiful thing. Peers in the industry, there's some people that are really good writers, and I won't tell you who this is, but a very well-known economist is calling this the immaculate disinflation. So I hope that doesn't offend anybody, but it's a pretty interesting term out there, because the Fed's been able to cut inflation without sparking a recession so far, and so far it looks like it's going to be able to do that. On the election, the executive summary is it's everyone wants it to be different this time. And we're going to share with you a couple stories of other decades. If you think this is so crazy and so different, we've never been here. We got breaking news in CNBC and CNN and Fox and all these, outlets that will tell you that and bombard you with it 24/7. But I'll give you plenty of times in the 50s and 60s and going back to Woodrow Wilson in 1912. If you think it's crazy today, I'll share some probably unknown facts. But politics, if you look at returns in election versus non-election years, they're about the same. If you look at returns through the presidential cycle, I don't care who's in charge in the White House or Congress, they're generally positive, and there's not a lot of separation between who's leading who. It comes back to the fundamentals of valuation and the technicals. And they drive volatility, as we all worry, but generally there's gridlock. And while we could bedazzle you with so-called policy differences between a Kamala, I should say, administration and a Donald Trump administration, there's not the degree of separation that you might think, even though you read about this, in terms of what can get done. And if you think you can speculate on policy that is likely to be promoted, passed, and then how people are going to react, it's a fool's game. It comes back to the stuff on the right. And then finally, on the concentration, it's a way broader market than is advertised out there. And we're going to show you all the statistics on that. We do think there's a wild card down there in 2022. I guess we would have looked brilliant. We said the wild card in 2022 was inflation. We should have made it a major wall worry item, and then we could be out there like, the rest of the bunch saying, oh, look, we made a great call. I think that the wild card and unknown, there is a deficit that's ongoing. And regardless of what administration's in there are drivers where that deficit is higher than we all would like. And it's not an immediate problem, but the bond vigilantes haven't cared about that at all. If they all of a sudden decide they want to care about it, if the Treasury auctions don't go well, they might jump in. That's not our base case, but they might jump in and drive rates back up. And that would be something for us to follow. So I put it as a wild card, just like I would have put inflation in as wild card in 22.
Perfect. Thanks for that overview. And I know you gave some headlines on a few of these risk factors, but I think now we can dive a little deeper into the key risk items. And regarding the first one, the Fed and inflation, can you give us a little more detail on why you think they are in the driver's seat now and poised to cut rates when they want to? Perhaps include in this discussion the progress on taming inflation, given that many consumers aren't quite feeling that yet. And also, we hear often that the Fed is hesitant to cut rates in an election year for the fear of interfering in the election. So is that true? So I guess that's more than one question, but I have full faith that you're up to the task.
Yeah, when you go to the doctor and he says, I'm going to give you a word, and then he tells you a story and throws all kinds, and then you got to remember the word or the
It's a test. It's for
that
sure
wasn't
a
as
test.
bad. Not as bad as that, but I think I got it. Yeah, if you fast forward, we've got a slew of slides and we're going to just rip through these
Oh, wait.
in sequential fashion.
Okay, here we go.
There you go. So the first thing I'd like to do, and you've heard us say this before, is just let's do put in perspective. People act like the Fed is in some big, deep, dark hole that has never been experienced before. And, this challenge of raising and then pausing and lowering rates is just crazy. All that the Fed has done, and this is part of our back to normal thesis, you can see what was unprecedented and abnormal was this blue line. The solid blue line is the federal funds rate over time going back to pre-1980, and the average is somewhere around 5%, and we're currently at 5.5%, pretty darn close to average. So that's normal. That's a normal through the cycle kind of federal funds rate. And what was unprecedented was zero. So we're actually happy to see that the economy has been able to hold up nicely, continue to grow as they brought us back to normal. So they're beginning from a point in which it's a little above normal, and they haven't caused recession. So they've got the leeway to begin taking it to normal or a little below that. And let's look on the next slide. One of the rationales is inflation coming down, and another rationale is no recession, and yet the economy has slowed. Unemployment's ticked up a little bit, and they're more balanced. I just said in my executive summary, they're able not to just focus on inflation, but keep their eye on full employment. And so as employment has ticked up from 3.4% or unemployment from 3.4 to 4.1, they can say, that's not alarming at all, but we now can afford to keep that in the background. And if that keeps drifting up a little bit, they're able to cut. This is a more technical slide. And what we show you on the dotted line, that blue dotted line, is the average after inflation federal funds rate. The average going back to pre-1980. Now, back pre-2000, when GDP growth averaged about 3%, real GDP growth averaged about 3%, we had stronger economic growth. That real federal funds rate averaged about 2.2%. It's pretty high, fairly high, about a little over 2. From 2000 through the present, when GDP growth has slowed more to that steady Eddie 2% level, that real federal funds rate has averaged actually minus 1%. But over the full time period, stronger growth, less growth, it's averaged just about 0.89% or 1%. So let's do the math. And this is the reason and rationale for why the Fed has good reason to cut when they want to, when they're comfortable, inflation's under control, and they've got a little eye on that unemployment rate ticking up a bit. The current rate's 5.5%. If the long-term average after inflation rate has been 1, let's call it 0.891, that means that 5.5% minus inflation of, let's call it 3% right now, the real after inflation Fed funds rate right now is really somewhere around 2.5%, way above the 0.89 and even above that 2.2% in history. So all of a sudden, people are going to say this is restrictive. This will slow economic growth. This could put us into recession. So let's begin in measured fashion, easing that down. So I think it's important to understand the math that they're looking at and kind of going through. And then on the next slide, I think we're going to get into politics here. You know, all these crazy things that you hear out there, like, oh, Jeff, yeah, the Fed can't cut, or hike. They don't do anything in an election year, because that would be seen as being political. I think Jerome Powell, part of it is posturing, but he's made it clear they don't talk about that in their decision room. And of course, some of that is posturing, but I think it's true based on history. He's got a point. And these are periods, election years, where they've cut on the top left, and election years in which they've hiked. And in 2008, they cut 7 times. What were they worried about? They were worried about growth. They were worried about employment. And they didn't care about politics. They said, cut, 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 cut. Drill, baby, drill. Well, this is cut, cut, cut. And the same thing down below, 5 hikes in 2004. So they'll do whatever they need to do. So stop this speculation about, oh, their hands are tied. And no, they're not. And we're more measured. We don't think they're going to cut a lot. We don't think they have to. Most of the time they got to cut because you got an impending recession and they've overhiked. That's not the case today. That's why I think they're in the driver's seat. And yet they've got plenty of reason to cut in measured fashion when they want. They've handled this pretty well. I don't know if I call it immaculate disinflation, but I'd say you did a pretty good job, Jerome, once you got going.
Yeah.
Next slide. And I'm really going to just shoot through this because I don't think we need to pound this point home too much. This is the alphabet soup of different inflation statistics. You hear about the consumer price inflation or the consumer price index, the core consumer price index, the personal consumption expenditures index, and the core PCE, and the producer price index, We've plotted them all in that bar chart, line chart. And in that line graph, they all peaked in 22 and they're coming down. And ex shelter, I can tell you right now, ex shelter, and there's a reason I say ex shelter, because new rents are coming down nicely, disinflating nicely. And when you sign a lease, which is 30% of CPI, rents are, you sign up for 12 or 24 months. And so you can't look at what average rents are overall in terms of rate of change. You need to look at the new ones coming on, and the old ones drop off with a lag. So the reason that CPI should continue to come down towards Fed target is because a big driver of it is really beginning to disinflate, and other items are doing the same thing. So, this is saying, hey, we've got some success here on the inflation front. And I'll add, people will, they focus on the fact that price levels are 18 to 20% higher than they were pre-pandemic. And that's true. And that's why people don't like it when they go to the store and all those items are still higher. That's true. But their income levels are 18 to 20% or more higher too. So their real spending dollars, while they're never going to tell you that, oh yeah, my paycheck went up, they're just going to complain about, that's what we do as human beings. And it's hard to tell somebody that, but that's the financial statistic that goes into and drives consumer spending and personal disposable income, real personal disposable income. So that's important. So the next slide. The one on the right gets at what's the growth rate? Everyone was worried about this would be 1970s and we'd have this awful wage price spiral. 4% average growth in average daily hour earnings on that right, that 4.17, that's the growth in average hourly earnings. But what is kind of missed is that because productivity, it has come up so much, and in inflation, if you look at inflation right now, the real growth in earnings are less than 1%. So I think it's important to kind of keep it in mind that number one, nominal average hourly earnings are coming down, and real average hourly earnings have peaked and they've started to come down after inflation earnings. And we'll see in the next part that productivity has increased, which is important. Oh, okay. I'm getting ahead of myself. 2 slides ahead.
Am I on the wrong slide right now?
No, that's okay. I mean, this gets at inflationary pressures. The number of people quitting is going down. There are fewer job openings. That was an inflationary pressure because everybody was quitting. They didn't know what they were doing. They're starting a new job. They're less productive, and they're able to go across the street and get some kind of raise. And you had all these job openings because they could go across the street. That's what allowed them to do that. All that's coming in and normalizing now. And small business plans to hire is also coming down. So these are inflationary pressures that are easing in the labor market, and it shows an easing in the labor market. And then I think we do have one on productivity. Could be crazy.
Here's this last one here in productivity.
Okay.
You see it?
So the blue line is the change in labor productivity, the growth in labor productivity. And you can see that labor productivity is now growing at close to a 3% annual clip. And so when you look at your labor costs, if your average hourly earnings are going up by 4%, but you're able to produce more as a worker per hour, and that productivity, you're able to produce almost 3% greater units, okay, then your real unit labor costs are only rising by less than 1%, the 4 minus, the 1. So this is key. It's not, while you're paying your people more, they're more productive because they're on the job longer. They got AI, they got other stuff going, and this is key towards maintaining margins. And we think this is an important thing.
Yep. Perfect. That's a ton of great information. And, much debated focal point of investors that have been in the news for some time. So appreciate that. And hopefully this helps inform all of you as to how we're viewing the progress on that front as well. Now, I think, especially coming up on the hour, let's shift, Jeff, you mentioned a little bit, so I'll go through these fairly quickly on just touching back on the election and the impact. This will really highlight some of the data to some of Jeff's earlier points. And this first slide here really illustrates what you were talking about in solid in both election and non-election years with not much difference in outcome. And the pattern of returns is more back-end loaded in election years as investors tend to gain more confidence only after they know who the winner is likely to be or who the winner is. And such back-end loaded timing of return is not guaranteed, of course, but this tendency does make sense. And the real key here is clearly that it's not it's the fundamentals. It is the fundamentals. It's not politics that are driving stock returns, given the parity in the election and non-election year stock return data. And then if we switch to go to this next slide here, you can see here that the fact that stock returns are positive. This is just a picture that shows some of what Jeff was referencing earlier, that regardless of who's controlling the White House or Congress, you see these positive stock returns. And that supports our thesis for focusing on the FVs and Ts, not the FVTs and Ps, P for politics, that are the catalyst for the stock returns. Then just a couple more slides here to really keep everyone grounded in why we don't believe in playing politics with our portfolios. So this first example really is showing you that, as Jeff was alluding to, not speculating on policy positions or potential legislation that could be passed if one presidential candidate wins. And this example here is showing you what you can see, that if you had gone long in a significant way on energy stocks following Trump's victory in 2016, that would have been a very costly move, even though Trump was and is considered the champion of fossil fuels and a more laissez-faire approach regarding the regulation of this industry. And the S&P 500 did well, but oil and gas stocks well underperformed the overall S&P 500 index after he took office. And then we can see the polar opposite of an example that played out following Biden's victory in 2020, as he being the champion of alternative energy solutions. If you drank that Kool-Aid and embraced the recommendations that you heard from many experts at that point in time and went long clean energy after he moved into the White House, you can see in this slide that you would have been very sorry had you done so. So really the point of the last 4 slides, and in particular these last 2, are it's very hard to know who the winner is going to be generally until the last moment of the election. Think Clinton Trump in 2016 or Truman Dewey in 1948. Jeff, you were mentioning some different time periods to really ground us in. So it's foolish to think you can speculate on policy likely to be championed when you can't call with any level of certainty who will win up until the last moment, and history makes this clear for us. B, even if you could predict the winner correctly, it is virtually impossible to know what policy will actually make it through Congress and be voted into law. And C, and maybe most importantly, even if you know with certainty what legislation and policy will be embraced, you still can't predict with accuracy how investors will react to it. So we suggest avoiding all of this altogether and not deploying any tactical bets in portfolios based on any sort of speculation around outcomes around politics, policy, and setting all of that, and to really remain grounded in the FBs and Ts, which Jeff, I know you and our internal equities team really pays a lot of attention to, right?
Yes, absolutely. Yeah. So, Katrina, I thought, I know we got a couple slides. I think as I think about the Magnificent Seven that are coming up, for time, I might truncate some of my comments about that.
Sure. Yeah.
So before we go to this slide, let me just say real quick, because in terms of history on politics, I just want to address the fact, and we do go back and we look at all kinds of things that happened, and everyone is saying this is unprecedented, it's terrible, all this venom and all this kind of stuff. I just want to throw a couple examples out real quick.
Sure.
I want you to go back to the 1960s. John Kennedy beat Richard Nixon by 100,000 votes out of 68 million cast. And there were significant rumors back then that because he won Illinois and Chicago, that there was election fraud. And at that point in time, the loser, Nixon, decided not to take action and go after that. And Kennedy became president, but it was uber close. And this was a horrible time in the world in which we had the Cuban Missile Crisis and almost nuclear war, a terrible showdown with Khrushchev. John F. Kennedy is killed. He's assassinated. Robert is his brother, assassinated. Martin Luther King is assassinated. We got Vietnam War. We're behind in the space race and did make a miraculous comeback, but that was kind of scary. The Soviets were way ahead. And the protesting from the Vietnam War was awful. In the 50s, we had McCarthyism and Red Scare too, and people were actually jailed. They were being called up in front of Congress to the committee formed to investigate subversive anti-American activity. And Leonard Bernstein, and you had a lot of people that were either blacklisted, some cases jailed, it was a terrible time, kind of in terms of the environment. Whether you're a citizen or a celebrity, just a normal citizen, it was scary. And we did call an end to it. And we also had the Korean War, labor shortages, inflation spikes, and all that stuff. And the market did just fine. And then back in 1912, Woodrow Wilson was the nominee for the Democratic Party in the 46th ballot in 1912. 46th ballot at the convention. And the Republicans were really, there's just a rebellion underway as William Howard Taft from Cincinnati, my hometown, was the president in 1908 and handpicked successor to William Taft. And in 1908, Teddy Roosevelt had a falling out with him. He decides to pull away from the Republican Party, form a Bull Moose Party, run against Taft, and the Socialist Party formed for the first time a candidate. You had 4 people running, and it was crazy. In addition to that, women couldn't vote, folks. And Woodrow Wilson jailed women that were protesting at the White House gates. He starved them. Then he force-fed them. He threatened to put them into an insane asylum. And when it leaked to the press, he said, yeah, maybe they should vote. I didn't mean that. And, when you couple that with racial riots and child labor laws and the sinking of Lusitania and marching to World War I, it was scary, man, but we didn't have CNN and breaking news to tell you how bad it was. So this is an interesting paradigm, but it really, truly, I think, is another example of the FETs that will drive things. So I just wanted to give you a little bit of history that is fascinating, to read. With regard to the Mag 7, I simply say, and I think this is the one slide that I'm going to show, and that's it, Katrina.
Okay.
The reason that we think the market's broadening out is because the red bar shows you the earnings growth that was generated by Mag 7 versus the non-Mag 7 component of the market. So the blue is the other 493. And notice how it was all Mag 7 until early 24, and that's why they just have done really well. But the other components now are coming into parity with the Mag 7. That doesn't mean the Mag 7 is going to do horribly, because they still have good earnings growth. But there's reason to think, and that's why we are a little bit in our internal strategies underweight the Mag 7. We have healthy exposure, but we're a little underweight, and we like some of these other stocks that are a little cheaper and have good growth. But it doesn't mean things are falling apart. You can see that earnings growth is solid, and that's why we think it will continue to broaden out just a little bit here.
Yeah.
So I think that's enough said.
That's great. Yeah, I think I do want to be mindful of the time. So we'll move towards wrap up. I don't want to ignore all of these slides, but I think I'd like to address one concern that we've heard a lot out there. We often get asked how this market can continue to advance after such strong momentum all last year and the strong start we saw in early 2024. So if you look at this slide, it actually shows the historical data regarding follow-on after strong first half returns. And you can see in this table that 2024 is this 14th strongest first half start on record going back to 1950. And after such a strong start like this in the first half, returns are greater than 10%. The second half of the year is positive almost 80% of the time, with an average second half return of 7.5%. And so I know we aren't necessarily forecasting such robust second half results, but a strong first 6 months certainly is not a warning sign of a tough second half when you look at the historical data. And often it can be a good sign for a good finish. And then this next slide just continues to demonstrate the same thing, but looking at it on a calendar year basis instead. So, last year was strong, with 2023 being up 26%. And so the question is this a cautionary sign that returns are likely to subside sometime in 2024? But the answer is clearly no. As you look at this slide, most common returns in the S&P 500 are years of 20% gains or greater, and the next most common are years of 10 to 20% gains. So seldom does the market go down or nowhere. and there are many repeat back-to-back years of double-digit returns. So the point being, a strong momentum year like 2023 or the strong momentum we've seen in the first half of this year does not give us pause on 2024 not finishing strong and not being having a strong overall year as well. So just wanted to set the record straight on that point real quick, Jeff, as I know that's a question that we get quite often. So Jeff, what other points would you like to make as we move into wrap up?
Yeah, I think we've got a slide on corrections, part of our back to normal thesis, which I think is important for people to know. As you know, we're not aggressively taking up our near-term target, and we do think that it's normal to have a 10 to 15% correction when you have wall items out there. But this is a historical chart, shows you year by year, going back to 1980, returns in the market, and the red dots show you intra-year corrections and the size of those corrections. And you'll notice there are, first of all, most of the blue bars are going up. So most years the stock market generates a positive return. And there are many years in which you have positive returns for the calendar year, but intra-year you have sizable corrections marked by those red dots. So I don't want people to think that it's wacko if we have, a 10 to 15% correction, and yet we still have a positive year. That's quite normal, and that's part of our back to normal thesis. And the market does trade off from time to time going into elections, depending upon what's going on, and then you get that strong fission. That's not guaranteed, but that's not an unlikely scenario. So that's point number one. And then the next slide, we're just going to repeat and put this back up here for you guys. The fundamentals, valuations, and technicals. What's the difference between a bear market and a correction where you hold your ground? In a bear market, when the market's starting to sell off and you're worried, this stuff is red. If you looked at 2000 and 2007, the fundamentals were rolling over. The advanced decline that is now positive, where most stocks are advancing versus declining. Back then, the market was continuing to go up, but the number of stocks declining outnumbered the number advancing. It was a very narrow market. You had a lot of reds up here. And that's the difference between hold your ground versus, this could be something greater. So corrections are normal. Don't fret them as long as this looks like this. And then what to do. And this is the final slide. We don't predict the predictors. We said before, we look for the trends. We listen to the trends. We don't try to predict the trend and reversals in them in terms of the fundamental valuation technical data. Patience is a virtue. It certainly has been, during pandemic in 2022, 2023 to avoid whiplash. We continue to hold ground and maintain normal exposure today. We continue to blend growth and value. However, we are looking at this kind of broadening in the market, a little bit of a rotation. We're slightly underweight the Magnificent Seven, and we'll continue to monitor that. We think active management can add value. The index may go nowhere, but if you got a bunch of stocks priced at 17 times when the overall market is priced at 21, there's opportunity for active management out there. Bonds, boy, isn't it great to finally get some yield out there and you can get 4% and get paid on your bonds? And we would also say that, in our overall allocation, we dedicate about 5% to small, mid-cap oriented stocks. They do tend to do well when you have a period where economic growth is solid, rates are coming in. It will be interesting to see what the regulatory backdrop is like, but they're very cheap. And, I'm not saying overweight by any means. I'm just saying if you don't have, a lot of people say, I just want domestic, large cap. And those are conversations between wealth advisor and client. But it is something to talk about. Have a conversation. If we've got a 5% allocation overall at the recommended level, maybe you want to think about those as a group. They certainly have had tremendous outperformance over the last couple of weeks. Will that continue? We'll have to see, but there are reasons to think they're cheap. They have some good catalysts, and there are reasons to think you might want to be at a normal kind of allocation there. So I'll leave it there.
Yep. No good points on maintaining an overall well-diversified portfolio across the entire segment. So Jeff, I appreciate all of your thoughts and observations. I'd say that's a wrap. I know there have been some questions that were entered. I think some of them we were able to answer as we were going through the presentation. For any that we did not get answered today, somebody will follow up with you and ensure that we get those questions answered. So thank you for the participation from our audience. And most importantly, just thank you for joining us today. We really appreciate it. We hope that you found this conversation helpful as we move throughout all the events in the second half of the year. There is never a dull moment out there, that's for sure. And we just want to thank you for your confidence and for allowing us to serve you. We'll gather with you again in January of 2025. Looking forward to that, to do another review and provide you an updated forecast on where we are at that time. And until then, be well.